Hello and welcome to Gold and Silver Assets. It's Sunday the 25th of October 2020. And when I first started doing these extra segments before the market report, I was a bit worried that I might run out of things to talk about, but that's certainly not been the case. All your comments and questions have given me great material to work with. So remember, when it comes to precious metals, what's your single biggest challenge, frustration, or question that you've been struggling with? Do let me know in the comments and I shall do my very best to provide answers. And today we're going to answer the question, how do the gold miners react to a stock market crash? Just to recap, a crash is different from a bear market. So we're defining it as a sudden dramatic drop where there's panic selling in the stocks and the drop is quite large in magnitude. Now there's no fixed definition in terms of the magnitude, but we're using approximately more than 10% drop in a few days. We're also just going to stick to stock market crashes that occurred in the fiat era. And so we're talking about 1987, 2008, 2010 and 2020. Let's start with 1987. So in the bars, we have the S&P 500 and the blue line represents the miners. Now, for the rest of this presentation, I actually used the HUI index, but of course, a lot of these mining indices weren't actually, they didn't actually exist in 1987. And so just for this one, I've had to use the XAU as a proxy there. And that's a gold and silver miners index. So what we'll see here, we're talking about this one-day drop that occurred on the 19th of October 1987. At that time, the S&P 500 dropped 20.4%. And I'm talking, when I'm discussing these percentages, I'm using the high at the beginning of the crash to the low on the end of the crash. At the same time, the miners dropped a similar amount, just a little bit less at 16.8%, but gold only dropped 2.75%. So that's quite a big difference in magnitude there. That's a 6 times difference in the drop between gold and the miners. Let's move on to 2008. And remember that 2008 was more of a bear market, but I have selected these days here from the 29th of September to the 10th of October, which is this bar over here. And on the chart, it looks like both the S&P 500 and the HUI, shown in the blue line, both moved down. Now remember that on these charts, they're just a comparison chart, so the scales are not equivalent. And so to look at the magnitude, we're looking at these percentages. The S&P 500 was down 30.6%. The miners were down a similar amount, about 30%, whereas gold only was down 10%. So that's a 3 times difference in magnitude there, three times of a drop. And then we will look at May 2010. That was the flash crash that occurred. And we're talking about the 4th to the 6th of May. So here to here. And again, in blue, we have the HUI index. And during that flash crash, the S&P 500 was down 11%. The miners weren't down nearly as much, actually. It was less, around a third less of a drop, whereas gold only dropped 1.6%. So again, that's around 2 to 3 kind of times difference there in terms of the drop. And then we come to more recently with the drop that occurred in 2020. And for this, I've used the whole decline. And here, the S&P 500 dropped 34.8%. The HUI dropped a similar amount, 33%, whereas gold only dropped 10%. Again, there's a 3 times difference in magnitude there between those drops. So from that, we can conclude that when the stock market crashes, the miners seem to fall by a similar amount to the general stock market. Interestingly, the miners also tend to fall 3 times more than the level gold drops. The exception to that is 1987. Now, that raises the question, why is that? If we look at the correlations, so on this chart at the top here, we've got in bars the HUI index, in gold we've got gold, and in blue here we've got the S&P 500. And at the bottom here I've drawn the correlation coefficients for these, and this is on the monthly scale. So in blue we've got the SPX correlation to the HUI, and this is the gold correlation to the HUI. And just eyeballing this, you can see that most of the time the miners are positively correlated to gold by a strong amount. So 1 is a strong correlation here. And here you can notice that it doesn't really go negative. So the gold miners do move very strongly in the same direction the gold moves. And as far as the stock market goes, it's very, very variable. It goes up and down. So overall, that means that the miners are more influenced by the gold price than the stock market. But how does that explain our conclusion in the last slide? How does that explain why miners fall 3 times more than gold? Well, that's not a question of correlation. That's more of a question of the beta of the stock. So to look at this, I've looked at the beta for the S&P 500 over here and for gold over here in comparison to the miners. And we've got some interesting observations here. The big thing is that for gold versus the miners have a beta most of the time of around 2. So what that means is that if gold moves up by a certain amount, then the miners move up by twice that amount. And you can see here that pretty much all the time the beta is more than 1. So it was only just 1 during 2012, 2013, but most of the time it's above 1. Now remember that beta works in both directions. So if gold goes down by a certain amount, the miners will go down by twice the amount if the beta is 2. It's very different when we're looking at the stock market here though. Most of the time the beta kind of goes between, well, here it's -1 and here it's 1, but most of the time it's around 0 really. So it's not really dependent on the stock market. But this explains what we're seeing. And my theory is that when a crash happens in the stock market, then margin calls occur, and that can cause people to have to sell their gold, which causes a drop in the gold price. As a result of the drop in the gold price, the miners drop by a greater amount than gold drops. And so it's not a direct relationship with the stock market per se. It's the relationship with gold, and gold can be affected by stock market when the stocks decline very rapidly in the crash scenario. Anyway, that's my theory. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. And we had this interesting structure that we drew over here, which is a upward sloping channel. And my feeling was that this was kind of like a bear flag. So if this was the pole, then this would be the flag. But it has gone on a little bit too long. So that suggests strength in the gold price on the bigger time scales. This is a strong bull market if you stand back and look at it. But in the shorter time scales, this is still looking weak because we have finally, over the last 2 days, broken down from that channel, and we've actually closed below it for the first time. And the thing to note, though, is that there hasn't been a strong downwards pull there. It's been quite weak and price has been hovering around this level. But remember that all-time highs from 2011 were around here anyway, and that seems to be causing a little bit of resistance for upwards movement. So I think there is a bit more downside to come, but don't expect it to be particularly dramatic. I don't think that we're going to go below around the 1760 level. I've tried looking at it in multiple ways, and I'm just really struggled to come up with any kind of good argument that has any strength for prices going below that level. So I'm plumping for further upward movement in in the coming months, but it just doesn't feel like it's quite ready yet. If we do go down, there are a few potential options here in terms of where it's going to turn around. One possibility is by joining the previous lows over here, and that would give us a downwards target of 1840, and that is perfectly plausible there. The other possibility is that we go through that, and so this trend line would be incorrect, and then we get into this area here. But I think this area here is going to be pretty strong. If we do try and touch this 200-day moving average, which is shown here in the blue line, then we're looking around the 1780 level as the bottom there. But I'm just becoming more and more skeptical that we're going to go much further than that. Let's look at silver priced in US dollars on the daily scale, and we've got a similar picture. Again, we've got this upward sloping channel, but again, it's been staying in this channel for quite some time. But the other thing to note on both of these channels is that it's spent a lot of time hitting the bottom of the channel here. It seems to be kind of weighted down over here. But the interesting point here is that we have a support level. So this greyish line is that trend line that goes back to the March lows. And that is a potential point to look for if I'm wrong and prices do actually go upwards from here. And that is a possibility. And in this case, we've got two potential support areas here. One is the bottom of this shorter term channel, as well as that longer term line. Someone else did mention connecting this low to another low further back, and that would give us a more shallow channel, suggesting a support area at around $23. And yeah, that's a possibility as well. And if we look at the 200-day moving average, that's coming up to around the $21 level. So those are the kinds of levels, if we're looking for more downside in silver, that I'd be watching for. If gold goes down into the 1780 kind of level, then I'd be looking at silver coming down to this 21 level. However, if gold doesn't go down very much, it goes down to, say, 1830, 1840, then we'd be looking at this as a level. But yeah, let's see what happens. I mean, there is potential for this to bounce up as with gold, but just on balance of probabilities and how things are looking, I think there's just one more little bit of downside before we get more upside. And that would fit in with the seasonality. So if you look at the video that I did on the best months to buy gold and silver, that suggests that buying points are going to be occurring somewhere between around now and December. But then after that, we're probably going to be off to the races. Let's have a look at the GDX on the daily scale, and this price is just gently moving downwards. There's no dramas going on here, and in the past week we've had this downwards movement with lower lows and lower highs, and the same with this larger structure here. So again, if we fit it with what we're thinking in terms of gold and silver, that would suggest a move down to around here, which is the high 35s. And if we look at the SILJ, now this is quite interesting, and what I've done again is join these lows, and we're just teetering on the edge there, which suggests something's going to happen next week. In fact, the next couple of weeks are going to be really interesting in the markets, and volatility is to be expected. But it's interesting because to me, this structure over here looks like a smaller version of what we saw over here, doesn't it? And again, this top bit here looks pretty similar to what we're seeing here. Anyway, I think that this is looking a little bit on the weak side, and we're going to get a bit more of a drop here, possibly to 13 or even 12. And before we go, I've got a heads up for those of you who live in the Australia or New Zealand time zone. There's actually a free conference that's online that's coming up in the end of November. I guess anyone from any time zone can join in because it is an online conference, but you just have to be aware of the time zones. Now, this is an Australian conference, and the keynote speakers are going to be Jim Rickards and Rick Rule. And the lineup looks pretty good. It's a one-day conference and it's completely free to register. So if you're interested, I've put the link and the details on the goldandsilverassets.com website. Just go to the events section and there'll be a link to show you where to go for further details. But that's it from this week. All the best. Don't forget to like and subscribe, and we'll see you next week. Bye.